If you were to sum up your investment edge, what helps you outperform not just the market, but your peers, how would you define that edge?
Yeah, it would be...
Will 2026 be the year for small caps? Today's guest thinks the setup is looking good for some of Australia's smaller and faster growing companies.
They only take the best of the best.
The best investment by far is anything that develops yourself.
Welcome to the Best of the Best series on Equity Mates, brought to you by Viola Private Wealth. Over 6 episodes, we're speaking to some of Australia's best investors to understand how they approach markets and what we can learn from their processes. Today, I'm speaking to Arden Jennings, co-head of emerging companies at Ausbil Investment Management and portfolio manager for the small and micro cap funds. I'm always excited to talk about small caps, particularly Australian small caps. It's our opportunity to talk about some of those companies that will grow into household names over the next couple of years or decades. But the particularly exciting thing about Australian small caps at the moment is the stories of Australian companies taking on the world. There used to be this trope in Australian investing that great Australian companies struggled to go overseas. Traditionally, companies like Seek and Car Sales and REA Group, that sort of first generation of technology companies, they had a mixed experience going overseas. Or we can look at a massive company like Wesfarmers who tried to set up Bunnings in the UK and came back with their tail between their legs. Australians haven't been great at exporting great Australian companies. But that is changing. And a lot of it's changing in the small cap index. There's some fascinating Australian companies that are really breaking out from our borders and going overseas. Companies that have gone through some great growth journeys have become household names, not just here in Australia, but globally. I'm talking about companies like Pro Medicus and WiseTech. And so when we talk about Australian small caps today, we're not just talking about companies that might pick up a market share in the Australian market, might challenge our, big top end of town. We're talking about companies that are truly innovative and that are truly taking on the world. And that's a really exciting thing to talk about. And who better to talk about it with than Arden Jennings? The portfolio he leads, the Ausbil Small Companies Fund, has delivered 27.7% per year net of fees since inception in 2020. So if there's anyone to give us the lay of the land in the Aussie small cap space, it's certainly Arden. But before we get into it, I want to say a massive thank you to our series sponsor, Viola Private Wealth. Throughout this series, we're hunting down the best fund managers in the game. And guess what? So are they. Viola manages over $2.5 billion by finding the best opportunities across public and private markets. Think of them as the talent scouts of the investment world. Find out more at violaprivatewealth.com.au. It is support from partners like Viola Private Wealth that help us keep all of our content free. Well, Arden Jennings, welcome to Equity Mates.
Thanks, Alec. Great to be here.
I'm excited for this one. Aussie Small's always an interesting part of the market, always a lot of good stories to unpack, and the fact that you guys consistently outperform the index doesn't hurt as well. So today, I want to start at a high level with your philosophy and then get down into the process, talk about how that philosophy translates to sort of your day-to-day investing. And then we'll talk a little bit about the market and how you see it at the moment. But let's start high level at that philosophical level. What is the core philosophy that informs the fund and informs how you invest?
Yeah, so our core belief is that earnings and earnings revisions are the key driver of share prices. So we want to be picking those companies that are upgrading relative to market expectations, and hopefully, if we're good enough, avoid those that are downgrading. We're a core or styling different managers, so we can be either value or growth. We just want to move in the market, wherever we can make money for clients. And I guess specifically towards smaller micro caps, we focus on sustainable business models. So obviously capital is harder to come by in the small caps relative to your large caps, and they need to self-fund their growth. So we want to focus on those businesses that are capital light, cash flow generative, low levels of gearing that can self-fund their growth.
And just as a point of definitions, obviously small caps change if you go overseas or you're in Australia. So for you guys at Ausbil, what's small caps for you?
Yeah, so we focus on the outside the ASX 100 primarily. we really focus on profitable and liquid companies. So how far we go down really depends on the level of liquidity, because we want to be able to move in as we see upgrades and hopefully move out before the downgrades come. So they need to be liquid and profitable companies.
So we're having a look at the fund, the Ausbil Australian Small Cap Fund. It started in mid 2020. Right as we're in the teeth of the pandemic, we'd had that March fall off, and then the questions were: is it going to get worse, or is it going to have a bit of a recovery? Take us back to the early days of the fund. I assume it was just a coincidence of timing, but what was it like trying to raise capital and start a fund and speak to investors and actually start deploying money at that time?
Yeah, it was certainly a roller coaster. But the background, we actually had an Ausbil microcap fund. It's been running since 2010. So we were running that fund prior to going into COVID. But we'd always planned to have a small cap fund set up because we've got a mid cap and a micro cap fund. And that was sort of a spot in the market that we thought, we had a bit of a gap. So we were planning to launch, and through 2019, and we were actually going to launch at the end of March, but we pulled back a month as we could see things unfolding. But honestly, it was a roller coaster. We started with obviously, one of the fastest market drawdowns in history, and then we had the reopening trade and markets roaring back with huge amounts of stimulus, and then you had the COVID beneficiaries that you needed to sell, the Pfizer vaccine, change of US president, all in that 2020. Then the IPO cycle really kicked off till the end of 2021, until Powell pivoted and inflation wasn't transitory, and you had the fastest rate hiking cycle in history. So look, it certainly was a roller coaster. We focus on a lot of wholesale money within our funds, so we're not institutional focused. So you've got to start, you've got to seed the fund, got to get on the platforms, get the ratings from the research houses up, warm up the advisors on the new product, and then eventually after 3 odd years, then they'll start to look at it. So it's certainly a journey, but really pleased with the support and grateful.
Well, I think one thing that certainly would help your conversations with advisors is the returns to date. 23% per year net of fees. You're not too unhappy about that, I'm sure. There's a lot of people trying to do what you guys are doing and are not delivering 23% per year net of fees. So if you were to sum up your investment edge, what helps you outperform not just the market, but your peers, how would you define that edge?
Yeah, it would be process, if that was one word I had.
Yeah.
But it's the relentless pursuit of the process. So you've got to be incredibly disciplined, and it sounds simple, but it's really not easy. And you can't get caught up on the day-to-day movements, of share prices. I remember a speech that Roger Federer gave, and I love it because in his over 1,500 matches that he played in total, he won nearly 80% of those. But if you look at the individual points, he only won around 54% of his points. Yeah, so he almost lost every second point, but he still managed to win almost 80% of his matches. So for us, share prices can fluctuate on a day-to-day basis. But when you look back over time, we're investors, we're not traders. Focus on the process.
Yeah, okay. Well, we're going to unpack that process throughout this conversation. But I guess if we talk about how unique the philosophy is, you mentioned you have a micro cap fund, a mid cap fund, now you've got a small cap fund. We're also speaking to fund managers that are in the large space, and then obviously that invest globally as part of this series. The philosophy you articulated was, at its core, quite straightforward, that earnings over the long term drives share prices. That's not unique to the small cap part of the market, but is there anything in your philosophy or process that you think is quite unique to the part of the world that you play in?
Yeah, so we at Ausbil manage money from the micro caps all the way up to large caps, and also have global strategies, but you really want to find them early in their stage of growth. But we have a 4-stage process, which is similar across all the strategies. We start with the macro, stage 1. We use it as a tool and as a guide to direct our research efforts where there may be opportunities, but also where there may be risks. Investment grade filter, focus on the profitable and liquid companies. So we filter the universe down from roughly 2,000 stocks to an investable universe of something like 200, and then have a portfolio of 40 stocks. 90% of our time is focused on stock selection. So that's doing bottom-up fundamental work, understanding how you turn a dollar revenue into a profit and modelling out each of our companies. And then portfolio construction, stage 4, making sure we have a well-rounded risk-aware portfolio.
Let's get to, I guess, the day-to-day investment process and kind of bring to life those steps that you just mentioned there. I'd love you to talk us through that process from, woe to go, I guess. Maybe using an idea that's in the fund as an example, but if you can sort of step through how it goes through those 4 steps and then ultimately into the portfolio, that would be great.
Yeah. Why don't we choose one of our largest positions and a really long-term holding for us? Life 360, ticker's 360. Everyone would say, oh, it's a crowded trade, and why would you be in that? Well, we've been there a very long time, but putting that process into action, we actually met the founder Chris Hulls and the team when they were floating in an IPO back around 2017, 2018, and had a number of meetings with them, but they weren't profitable and cash flow. We couldn't see cash flow break even within sort of the next 12 months. So we actually passed on that IPO, but we stayed in touch with the company, kept meeting them, doing our work. So from a top down, we were positively disposed to, technology companies that ticked that box, but didn't pass sort of the second stage, which was, have they come to cash flow break even and can they self-fund their growth going forward? So we waited, and it wasn't till early 2021, 22, around then, stock price was around $4, which wasn't too far away from where it actually IPO'd. So we didn't waste our capital sitting there for a couple of years and waiting for it to come to a point where it all comes to fruition. But then we started to invest in the microcap fund, and then it graduated into our small cap fund, and we started investing. So we have a reasonably large position in that fund since we scale in, and it got to a point where we may have had 5 or 6% of the fund. In Life 360, it's say $7, and then they announced advertising, and it's up 30%. I think it was March, around the March 1st, 2024, and it sort of goes to $11, $12. It's gone to 20, 30. It's gone up to 50. So we have trimmed along the way. Otherwise, it'd be a huge part of our portfolio. So that's that stage 4 coming in as well, right? Like making sure that we, trim the hedges all the way up and have a responsible position size within that. But all the while over the last few years, we've been doing, bottom-up work. We're speaking to customers, suppliers, competitors, and we love founder-led businesses as well. That's really another core part of, small caps and micro caps backing founder-led businesses, which I'm sure we might touch on later.
I'd love to follow up on Life 360 as an example, because it's certainly getting a lot of conversation at the moment. And you're right, it's more and more crowded as more and more people speak about it, more and more people realize, what it's building and what it's sort of doing. How do you think about continuing to monitor the position when it's not just a trim, but it's okay, this is overvalued, or when the growth can still grow into the valuation? Using Life 360 as an example, how do you sort of monitor and make that continue holding or sell decision?
So going back to our philosophy, earnings revisions, the key driver of share price. So as long as we can continue to see upgrades, we'll continue to hold that position in the fund, but we'll weight it appropriately, and look at the valuation and the risks. If the thesis is broken, say something changes dramatically that would break the thesis, we will exit the position. But, it's obviously come back more recently. It's come back from its highs of well over $50 to, come back well over 30%. So we've been buying that, and you'll see that, we're one of, if not the largest institutional shareholder. Ausbil as a house, it's held across various strategies now. So you've got to be disciplined. You've got to trim the hedges and pluck the weeds. And look, I hope 360 doesn't become a weed at one point, but you got to be disciplined, right? When the facts change, you change your view. And we've got a thesis for every stock. So yeah, it's a balance. Speaking
of balance, I'm interested in how you balance the top down that sort of starts your process, and then the bottom up. I'm sure there are some stories where the top down and the bottom up are sort of singing from the same hymn sheet, and Life 360 might be an example where there's a lot of macro tailwinds and technological adoption, all that stuff, and then bottom up the company looks great as well. But I'm sure there are some times where maybe the industry doesn't look great, so the top down doesn't look as nice, but you really like the bottom up. When those two things kind of aren't so aligned, how do you find the balance between the two?
Yeah, so we say the macro is only about 10% of the input into the process. It's just a tool and a guide to direct us. So, let's cast our eyes back to the end of 2021. Around that time, we had less than 2% of the portfolio in IT. I'm just using a sector as a representative, right? Yeah. When inflation was meant to be transitory, and it clearly wasn't. Inflation was stickier, and we saw what happened in 2022. We had the fastest rate hiking cycle in history. If you're a growth manager and tilted towards growth, you absolutely smashed.
Yeah.
Value had a much better year. I think Small Ords was down roughly 18%. Our fund was only down 10 because we'd use the macro as a tool, as a guide to say, hey, there's some risks here. If inflation's not transitory and interest rates need to rise, that's going to impact valuations, particularly for growth companies, particularly those in the technology sector. So although we really liked companies like PME, Pro Medicus, that we didn't own at the time. We would have loved to buy it, but we did buy it in 2022
Oh, nice.
when it had been smashed, around June, July of 2022, when valuations had massively reset. And we thought, well, valuations come back, still a great company, perhaps the worst of the rate rises have played out. So you don't want to be in companies that are overvalued, also have significant leverage from a financial standpoint. So indebted companies, that's a recipe for disaster.
Do you still own Pro Medicus today?
No, we don't. It's gone into the 100 and graduated.
Yeah.
So we have, exited that one. Would have loved to held onto it. Look, generally we'll exit within 12 months. We can hold on to companies for longer than that, but we want to still stay true to label as a small cap manager and find the next PME, within the portfolio.
Yeah. So if I was to ask you what's your view on the valuation of PME at the moment, you would say not in my index anymore?
Oh, we have a view on every stock internally. Ausbil cover the ASX 200 with an analyst. They've got a positive recommendation on it.
Oh, okay.
So there's earnings upgrades, to come, but you've also got to balance that with the valuation, and you're not going to probably have it as your largest position in your portfolio.
Yeah. So when you're running through the process, both at the top down and thinking about macro, and then bottom up looking at an individual company and its prospects, are there any particular inputs you really rely on, any sources of information that are sort of your go-tos? And I guess on the flip side, any that you perhaps don't put as much weight in as other people would?
Certainly say you've got to back yourself and your team as well. So I think they're the most reliable, inputs that you're putting in. You only get out what you put in, and you've got to back yourself and the team and what you think is right. So we are high conviction, bottom up managers. But also what I'd avoid is, I hate FOMO and meme stocks and retail mania that gets caught up in these narratives and themes. Hot IPOs. So look, we try and avoid that. We're investors. We're not traders. We're not speculators. We just want to invest in quality companies, and there's so many to choose from in our space that we can still make really strong risk-adjusted returns for our clients and meet our investment objectives, which we've done really successfully to date. Without having to take that sort of risk.
To go back to the philosophy where you said we're looking for earnings upgrades and we're trying to avoid earnings downgrades, part of that is understanding the company, but then it's also understanding the company relative to the forecasts it's making and relative to what the market expects from the company. What sources do you rely on to really get a sense of like where the market's expectations for the companies are?
There are data source providers. We all have access to Bloomberg, if not FactSet or Visible Alpha, which have, various collation of all the data that the analysts are forecasting. And then we make our own assessment on what we think, the revenue earnings should be relative to the market. But we're also having input, from, the banks, both globally, domestically here, whether it's on the investment banking side or also on the sales side, and what the views are of the market. We also monitor, how crowded trades are and, how well held some of these names are, and also the structural rise of, passive investing, which has had a huge impact on the market for us. So we're aware of positioning as well.
Yeah, okay. Because then one source would be, all the consensus estimates. And then the other would be like, what's the company forecasting? And I imagine some companies would be chronic under-forecasters, and then others would be perhaps overly optimistic in their forecast.
Yes.
And then how much are you factoring like who's doing the forecasting and like which company is doing the forecasting into your analysis?
Yeah, so I think this is a massively underappreciated part of the market for companies, understanding how the market operates. We want to under-promise and over-deliver. You let your results do the talking, and you want to see companies that are just incrementally upgrading their earnings, over time, consistently. You don't need to blow it out of the water. We come out with a 10, 20% upgrade. That can cause, very short-term spikes in your share price. But if you're just upgrading by 1, 2, 3%, maybe at your AGM, your half year, your full year, maybe you've got a conference or a presentation that you're presenting at, providing those incremental positives, but keeping expectations in check. When you overpromise and you underdeliver, you see the multiple D rate, and the share price is reflected. So in that.
Is there any, and it doesn't have to be a company that you hold in the fund or even one in your index, but is there a company and a CEO or a management team that you think manages that forecasts and expectations really well, like does a really good job of putting information out to the market in a consistent and structured way? Yeah,
I think there's plenty of companies that do it well, but it's obviously incredibly difficult and never perfect, and the market will always nitpick at things. I think the Pro Medicus guys have done a fantastic job in terms of this is the minimum contracted value that comes through for this contract that we've won. Then the analysts will go put that number in there, but then there's always upside to that as they go and implement. Life 360 have done a really good job. They've been through that journey of not meeting expectations with the market. They've really reset in the last few years, and you've seen what's happened. They've managed expectations really successfully to date. So look, it's it is incredibly hard. It's more of an art than a science.
Yeah, and I'm sure if I asked like different parts of the markets or different managers, different people would want different things from the companies they're investing in. So it can't be a one size fits all.
Exactly, and expectations or people wanting short term results versus medium and long term, and what's in the interests of businesses, and that's why we like founder led businesses, because they'll focus on the long term interests of shareholders, even if it's at the expense of short term profits.
I want to turn to the downside, because there's two sides to your philosophy. The other is trying to make sure you're out of companies that are about to enter a downgrade cycle, and I'm sure that's easier said than done.
Totally.
But are there any particular red flags or leading indicators that sort of get your antenna up and you're like, oh, this is something I need to watch out on?
Well, we're always looking at what consensus expectations are for companies, and then balancing that obviously with the valuation behind that. There are plenty of red flags. Whether that's insider selling, if a founder or someone really important in the business is selling a significant portion of their stake in the business, we know incentive drive behaviour and alignment of interest is really important. So, that can be a red flag. Even the way that CEOs are incentivised, how are they incentivised to grow revenue and EBITDA, but not earnings per share? They can go and acquire through M&A an empire build into a bigger corporate, but if EPS isn't growing, that's not accretive to shareholders. So, that can also be a red flag. There's plenty. We monitor each of our companies. You should be able to walk out of a meeting and sell the stock if you hear or see something that is wrong or you don't like and is a red flag that a spreadsheet won't tell you. And look, to be honest, we do get lied to all the time. Sometimes it's not intentional, or it's inadvertently. Things change, and sometimes it's in their control, sometimes it's not in their control. So look, markets are challenging. They're always challenging and tricky, but that's what makes it so fun for us.
Yeah, I mean, when you speak about insider selling, obviously people's mind go to the big example in Australia recently, which is the Drone Shield example. Any thoughts on that company at this point?
Yeah, we haven't invested in Drone Shield, I can say that. I don't care what benchmark weight it is in the index. When we think about the composition of the index, we think about things in absolute return. What companies are we confident that can deliver a positive absolute return as opposed to, covering some benchmark weight? Because if a stock goes down 50% and we're benchmark, you've still lost 50% of that position and that capital of your unit holders or investors in the fund. So, look, we don't have a position there. We found other ways that we think are, provide more risk-adjusted returns. Codan's a good example that still has exposure from the metal detection side of the business, which is exposed to gold, but also the tactical side, through public safety, 911 call centers in the US and globally, but also with their tactical division, which is selling communication equipment into drones as well. So not one that we've invested in. If you can't understand how they turn a dollar revenue into a profit and be able to assess the earnings, we just haven't been able to get confidence of what will the revenue be. How are we going to get there? And then how does that flow through to earnings? So there's plenty of opportunities out there for us.
Yeah. No,
not to mention the hype and,
when you said earlier that you hate retail mania stocks, I was like, Drone Shield was that.
Oh, it's more getting caught up in the hype
Yeah.
and FOMO.
You mentioned something there about not managing the index, which I find interesting. And I think particularly in your large cap peers space, they all sort of went through a couple of tough years of how should they think about managing the index with Commonwealth Bank when it was acting more like a growth stock than a large bank. But a lot of active fund managers weren't in the stock. Has seeing that experience made you think about managing the index in a different way or managing it at all, or are you guys just you're index agnostic?
Yeah, we're index agnostic. What I'd say is, though, if, for large caps, they've got the challenge of, the top 10 companies comprise, around half of the index. So, it's a big call for them to make whether they're overweight or underweight. For us, the top 10 in the small ordinaries, the largest position is generally around 2%, but the top 10 would be only, something between 10 and 15% max. So, we've got 200 companies to choose from. It's pretty spread. And there's plenty of opportunities beyond, obviously, outside the 300 for us to choose from. So, yeah, that's a good challenge for them. I think it's much easier for probably a small cap manager to then manage a mid cap and then a large cap portfolio because of the way that they think. It's hard for large cap managers to come down and come into small caps. It's so volatile. They're like, oh, this is too volatile for me. So
okay, all right.
Yeah.
So for any budding fund managers out there, they should start in smalls and then go up the size chain.
Well, yeah, if that's your career ambition. But look, I love my job, honestly. I love doing micro caps, small caps, and seeing them graduate into become, mid caps. So it's an exciting part of the market.
All right, Arden, I'm going to take a quick break here to say thank you to Viola Private Wealth. We spend this whole show talking about who's the best in the investing game. But here's the thing. Most investors can't just pick one fund manager. That's where Viola Private Wealth comes in. They're like the selectors, building the dream team, taking the best from different markets and asset classes to create something that actually works for your life. Whether you've just sold a business or are looking to diversify away from a traditional property portfolio, they'll help you build a strategy that makes sense for you. Managing significant wealth should not feel overwhelming. With Viola Private Wealth, you will find guidance that is personal, practical, and results-driven. Learn more at violaprivatewealth.com.au. Well, I want to turn to the market and sort of how you've seen this year and how you're thinking about the year ahead. So 2025, I think, in a word, was wild. How would you sum up the year that was?
Yeah, it's certainly been a roller coaster, right? But I'd say it's the year of small caps.
Okay,
finally.
okay.
So we've had a few years here where, we've been pushing, small caps versus large caps are trading at, at one point they're trading at 2 standard deviations below their long-term average. The cheap seats have been taken and we've seen, small caps start to outperform this financial year and even calendar year to date, they are outperforming. And we're getting the benefits of, 3 rate cuts here in Australia and monetary conditions globally. Rate cutting is pushing people into, perceived higher risk asset classes. So it's been the year of small caps,
Nice.
but look, it's been volatile, right? We've had, April, we've had the Liberation Day. We've had a tech sell-off recently here in Australia. There's always something going on, but every year there's something new, and that's the challenge in markets, right? We've just got to navigate them.
It's the challenge for you. It's the opportunity for us here at Equity Mates. There's always something to talk about. Yeah. So if you think about where the market is today and what that reflects in terms of how investors are thinking about what's to come, do you think there's a widely held view or a consensus view on the market that is going to be challenged or is just straight up wrong?
Are we in an AI bubble? I'd say no, we're not.
Oh, interesting. Okay.
But at the same time, do I believe in, crypto and Bitcoin being the next, major theme or structural trend over the next 10 years? I'd say no.
Okay.
There's going to be winners and losers in AI, and there's so much capital being thrown at this. We're going to see, particularly in the US, this is an arms race, with the US and the rest of the world. Huge amounts of capital being thrown at this. We're going to have, productivity benefits coming through from this. There are going to be pockets where there are losers from all of this, but I guess it's our, job to try and navigate, where the opportunities are and try and pick the winners and avoid the losers.
So I'd love you to unpack more why you don't think it's a bubble.
Look, our companies are already, seeing the benefits of, spend in AI, whether that comes down to, a simple example, Temple & Webster, over the last 12 to 18 months has talked about the customer service costs. They've been able to service more customers with around the same or less customer service costs through, AI and automation. They've made investments there. But that's just one simple example in the Australian market here, and offshore as well. Like, there are going to be productivity benefits, whether it's through efficiency and productivity gains, over in, particularly in the US, and it's obviously led by a very narrow few group of companies. But we think, the benefits of that, will go to those that adopt, more efficient practices, and it's all going to make, our lives, a lot more effective in what we do. So, but there will be losers from that, just like there has been through cycles, and industries such as newspapers and things like that. TV and radio, they've all been disrupted. So we do think it's going to be disruptive. But are we in a bubble? There are going to be losers. I want to make sure that's clear. But there also is going to be some winners out of this.
Yeah. But it's not like January 2000 is what you're saying.
That's not our view.
Yeah. Obviously, a lot of the AI plays are in the large cap space, particularly in the US. How have you found the best ways to express the AI theme in your portfolio?
It's a good question. We're constantly thinking about how some of our businesses could be disrupted, but also the opportunities. So, when we think about the AI theme, let's just go a level down. There's going to be, huge demand for resources, whether that be through copper and the electrification and battery storage, upgrades of the grid, but also energy consumption is going to be huge. And whether that's relying on renewables or other forms of resources to be able to fuel that, they are incredibly energy intensive, data centers and the like. So, we want to try and find those companies that are capital light business models that are going to benefit from that. And there are opportunities in the small cap space. Yeah.
Any names you think are worth researching?
We have looked at, some of the players like Genus Plus, which is involved in a lot of the rewiring the nation and electrical work. But there are other players in the space that can benefit from that. But there's going to be broad benefits here across many industries. So I don't think it's going to be defined to, one sector, whether it's, a copper producer like Sandfire or an energy producer. I think there's going to be wide-ranging benefits here for everyone.
I love that. I mean, I feel like the AI conversation is certainly top of mind for people, but I'd be interested to go beyond the AI conversation. Are there any particular parts of the Australian economy or the Australian market where you think there's interesting opportunities that are maybe being overlooked by a lot of investors?
We still think small caps have plenty on offer. We still think tech is, proving to be, a really good opportunity to continue to invest in. There's also other up-and-coming sectors as well.
We love a bold prediction here at Equity Mates. So as you think about 2026 and what's to come down the pike, do you have any bold predictions you'd be willing to share for the year ahead?
Yeah, look, I don't know how bold it's going to be, but look, we think the US growth is going to surprise to the upside going into next year. There's a lot of doomsday sayers out there and doubters, I think, but what we're seeing over in the ground in the US is that growth is going to accelerate next year. Whether we get another rate cut or two coming remains to be seen. But growth, we think, will surprise on the upside next year. I'd probably caveat that with, we are going to have volatility, which is going to create opportunities. We've got the US midterms coming up next year. So we need to be careful and mindful of that, political or geopolitical risks in the background. So it's going to create opportunities, though, when there is volatility to buy good quality companies at a discount. But focus on the US.
Now, people may be surprised, you're an Aussie small cap manager who's talking about the US economy. Why is that sort of the starting point for a lot of the conversation?
Oh, whatever happens in the US, if they sneeze, we catch a cold, right? Okay. Like we do follow the US. Whatever happens there, we'll follow with a bit of a lag. But when we look at it holistically, we think there are opportunities in the US that are going to present themselves, and we can get exposure. Life 360's a great example of exposure over there, but there are also companies coming out of the top 100 potentially later this year, such as Reliance and Reece, that obviously have US operations. So we'll have a close look at them when they come up. But it is hard to get exposure to pure US exposure, obviously within the small cap space.
I love an optimistic prediction, and so I'd love to understand where the positivity around the US is really coming from, because I feel like we're pretty privileged here at Equity Mates. We get to speak to a wide range of managers, and I feel like there's a wide range of views on what's going to happen in the US next year. On one stage, it's like this capex super cycle is going to continue, and that's going to trickle down to the rest of the economy, all the way through to like the other side being that the US consumer is really challenged, and that's going to be where the challenges start in the US. So if you think the US is going to be above forecast, what's the reason for the optimism?
Yeah, you probably mentioned a few things there. There is a huge amount of capex going into the US, trillions of dollars over the next few years, and that is going to generate some return and stimulate the economy. So, the efforts we've seen, by large US corporations and offshore corporations to invest into the US is going to drive a capex super cycle. So that's obviously positive. Rate cuts clearly are going to benefit. The home builders are on their knees in the US. It's been quite 30-year mortgage rates are quite high, but there could be changes coming in that space as well from a market structure or regulatory perspective that could positively impact people being able to switch and move between homes. So there is deregulation happening over there in the US that is going to free up business activity, which we think is positive for the US. Yes, there are pockets of weakness. There always will be, and we are seeing a bit of a K-shaped recovery here, and that's been very widely spoken about. With the wealthier getting wealthier, and the more underprivileged consumers really struggling, and we've seen that obviously with tightening of borders over in the US as well, and immigration. That's obviously had an impact, but there's certainly elements where there are pockets of weakness, and we're seeing that K-shape recovery potentially in the consumer. But look, rate cuts should help in the US as well.
Australia had a surprise inflation print recently, 3.8% headline. How much does this sort of, quarter to quarter, but now we're getting monthly inflation numbers, so month to month inflation numbers impact what you're doing from a portfolio level, or is a lot of it just noise? Yeah,
I do want to stress we're 90% bottom up, so I know we've spoken a bit about the macro here. It's about 10% of the input, but what I would say is that we've had 2 negative prints from a CPI perspective, surprise on the upside. So our counter consensus call would be rates are actually on hold now.
Yep.
We're not going to be in an easing bias. So, the risks are not to the downside with rates being cut, be more likely to the upside, And that would only be because growth is stronger than expected next year, and unemployment is lower than expected next year. Hence why we don't think we're going to get rate cuts next year.
Well, you flagged that I'm asking you a lot of macro questions, but you're 90% bottom up. So let me ask you a bottom up question, and I'll just ask it generally. Is there one company that you think is just super exciting at the moment? Like, obviously, everyone needs to do their own research, but that you're really excited, that's in part of the fund, and you think is prime for a big 2026?
Yeah, look, obviously we take a portfolio approach, so I want to stress that.
Feel free to give us your whole portfolio if you want to.
we do provide our top 5 in our monthly performance report. You can have a look at that for the small cap and micro cap funds. Our top 3 positions at the moment are Life 360, TUAS, and GDG, Generation Development. TUA, TUAS being the telco in Singapore that David Teo, the founder, runs, but focusing on Life 360, share price has come back, from well over $50 back, to under $40 roughly. So we think that creates a fantastic opportunity. Over 90 million users globally. They've got around 16% of the US population penetrated, and they're moving into pet. They've sold out of pet. That's another growth lever for them. That's going to convert into more paying circles, which we've seen. The market's taken a bit of a wobble on, their focus on converting more of their customers and less on the top line and growing those MAUs in the last quarterly. But we don't believe that that is something that's structural going forward. There's a huge white space opportunity for them to focus on driving top line monthly active users. They're the free users before they actually convert into paying users. And then, there's other opportunities down the long term, like, moving into elderly care as well. So, there's huge total addressable markets here for them, and stock prices come back something like 30-odd%. So, we see that as being on sale.
Love it. Arden, I want to move to a couple of final questions, and then I've got like a rapid fire closer. This is another top-down question, so forgive me, but I'm going to ask it anyway.
Go for it.
If you were to think forward 10 years and you had to back one theme or structural trend, what would you choose?
Yeah, I might have touched on this earlier, but I'll tell you what it's not. It's not crypto or Bitcoin.
Yeah, okay.
I really don't want to say AI because I feel like everybody's saying AI is going to do that, but I'd look at the layers below that. So going back to, I think, what I was alluding to earlier, who are the enablers of AI? I think, we're going to require huge amounts of copper, huge amounts of energy consumption. There's all, upgrades of the grid. Those enablers are really going to benefit over the next 10 years. So you want to be aligned to those companies that are servicing AI and hopefully not being disrupted by AI.
I feel like there's a whole other conversation we can have about your views on crypto. I don't think they're very positive.
Maybe.
If you can think back to your 25-year-old self, what's one piece of investing advice you would give?
I'll go one better. I'll go back to my 15-year-old self,
Love
another
it,
10
love it.
years.
Yeah.
Get a job, invest, and do it early because the power of compounding is huge over time. So, fortunately, I did do that when I was young. My first official job was actually in Domino's, and used that money to invest in Fortescue, which was a micro cap at the time, and have watched that journey of growth over time. Learnt many lessons along the way, but that sort of lit my passion and fire for smaller micro caps.
Epic. Jeez, good first stock pick.
There was others, but
Okay,
that was my 15-year-old self.
Yeah, nice. All right, well, throughout this series, we've been closing with a bit of a rapid fire game to close it out. Just give me the first thing that comes to your head.
Okay, I'll do my best.
Yeah. What's one stock or asset class you're excited about?
Oh, small caps. Got to stick with small caps.
You're on
still
message.
seeing rate cuts coming through.
Nice.
Stick with Aussie small caps. Active small caps is the point.
What's one thing you changed your mind on recently?
Mining services. I think that sector's attractive. They're cheap. I think stock price is going up. Companies are saying the horizon that they see is the best in decades. So there's a huge amount of work on.
Oh, wow. What's one underrated investing skill?
Being able to read people and having a good memory.
Oh, nice. I like that. Good memory. Yeah. One investing myth you would banish?
Investing in the share market is like gambling.
Love that.
Leave that to crypto.
Yeah. Is there a book, a podcast, or a documentary you'd recommend?
I like listening to the NAB morning call every morning. It gives you a snippet of a rundown of what happened overnight before I start reading the overnight emails that I get through.
Yeah,
every morning.
nice. And finish this sentence. Great investors
Are unemotional. You can't fall in love with stocks. So when the facts change, you got to change your view.
Love that. Well, Arden, thank you for joining us on Equity Mates today. I've taken a lot out of this, and I'm sure the audience will as well.
Thanks for having me, Alec.
That's it. Thanks for listening to this episode of our Best of the Best series. This episode was brought to you by Viola Private Wealth, personal, practical advice for managing serious money. Learn more at violaprivatewealth.com.au. And make sure you're subscribed wherever you're watching or listening to this episode so you don't miss the next one.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.